People should be cautious about all of their investments. And even though you and I don't invest necessarily in hedge funds directly, but it's important for us to understand that our pension funds may invest in hedge funds. So you and I may be invested in hedge funds. A mutual fund is happy to have losses when the market is down, as long as it's having less losses than the market on average. But hedge fund will always want to have a positive return. This results in the fact that hedge funds use much more broader array of assets, such as buying assets, but also short selling assets, and uses derivatives and leverage much more aggressively than a mutual fund can do or would do. The purpose of this conference is to bring together academics, people working in hedge funds, people working with hedge funds, as well as regulators to discuss issues that are relevant to hedge funds. Not only directly related to hedge funds, but also things that are indirectly related to hedge funds. So for example, in the program today, we have some papers that have nothing per se to do with hedge funds, but they talk about, let's say, investment strategies that hedge funds would employ. And we will be talking about the risks and returns and sources of those risks and returns of these strategies. So although we're not talking directly about hedge funds, we're talking about something that is relevant to hedge funds and hedge fund investors, and maybe also to those people who are regulating the hedge funds or maybe thinking of even deregulating this industry. I think a lot of the emphasis of research on hedge funds is about demystifying hedge funds. So hedge funds are mystified because they are less known, less transparent, or actually quite opaque. I also think some hedge funds want to remain that way because mystery also makes them special and maybe allows them to charge a bit higher fees from their investors when they're slightly more mysterious. The point of this conference is to look under the hood of these somewhat black boxes of hedge funds and try to understand what do they invest in, what kind of strategies they employ, what are the sources of risks and returns in these strategies, what are the effects of these funds on the market and on various kinds of outcomes, and maybe how we should think about hedge funds as investments and how hedge funds should manage their own portfolios. In my work, I have studied hedge funds quite a bit, and one of the key results that we've found is that hedge funds act as liquidity providers in the equity market. So this is one example of this demystifying the hedge funds. So we look at a large sample of hedge funds and find that on average these funds tend to provide liquidity to other investors in the market, which actually is a useful service to the market because this allows other people to trade at a lesser cost. What we learned today is there's still a lot to be done in terms of research in hedge funds, in terms of the strategies that they employ. What are the true sources of risks and returns in these strategies, and how does that matter to the hedge funds themselves, and maybe more importantly to the people who invest in these hedge funds?